Let's talk inflation and what you can do about it, especially when it comes to investing. And in particular, I want to discuss the role of tips alongside inflation. But when I say tips, what I'm not referring to are what you give or receive when you're working maybe in services, such as at a restaurant. That's not the type of tip that I'm talking about. I'm talking about a treasury inflation protected security. And I'll give a little bit of the reasons for why these investment vehicles exist. But before I do, I just want to give you a quick reminder. Be sure to subscribe to the YouTube channel and then to follow us on LinkedIn and Facebook, and then consider signing up for our newsletter. All that's included down below in the links. So we'd love to have you join in any one of those. But what is a tip or tips, as they're also known, and why do they exist? And I think to describe some of this, you have to understand the nature of a bond investment and the pros to those bond investments and some of the cons invested. And I won't go into all of the pros and cons with bonds, but one of the biggest issues that we have is reinvestment risk with a bond and the possibility that the stated interest rate that bond yield will have, what's the coupon rate, is not sufficient to keep up with inflation. And so a bond as a reminder is kind of a lending arrangement where you give money to another entity, organization, perhaps the government, and in exchange for that lent money, they pay out a stated coupon payment, usually once every 6 months. Could maybe come out to you in monthly payments or once a year payments. Kind of depends on how you're investing in this, but the amount of payment is based on, well, how much did you invest and what was the interest rate stated, and they just pay you rather straightforwardly whatever percentage of that interest rate is to the annual, what the par value, the principal value, and then that gets divided up between 1 or 2 or 12 depending on how often the payment is supposed to be made. And so what can happen is, maybe the stated rate on this bond is 2, 3, or 4%. It could be higher depending on the credit risk of the lending institution. But the challenge is, well, what happens, especially if I'm looking for some stability and getting what's called back fixed income, like an income source, in particular if I'm in retirement or have certain living needs that I need to have maintained. That's typically when you would put a bond investment to work for yourself. What happens if inflation, isn't at 3 or 2 or 3 or 4%? What if inflation's at 5 or 6 or 10%? What you can have is what's called an erosion of purchasing power, where what that yield, that return on this investment is not keeping up with my spending needs. Not because I'm increasing my spending and I'm going on bigger shopping sprees. It's because things have just gotten more expensive and my dollar isn't stretching as far as it's used to. In fact, it's shrank. And so this yield is shrinking effectively. And so how can I protect, against that is the question. And so that's where tips come in. They were designed as a potential solution, a potential answer to this problem where specifically, U.S. tips, created by the government and having the backing of the U.S. government and largely seen as guaranteed and secure. So very low risk, at least in our line of business, we see it as very low risk. What the government promises to do is they say, hey, look, let's say you invested $10,000 and it was a 3% rate, a coupon payment on that $10,000, and inflation does go up. Again, only 3% coming out. Now we're seeing kind of a loss of purchasing power through that. Instead, what we're going to do is we're going to adjust the principal by the inflation rate. And so you had a $10,000 principal that was initially invested, but due to inflation, if inflation has gone higher, that $10,000 isn't worth what it used to be unless we adjust it by the inflation rate. And so now we'll adjust the principal from 10,000. This is what the government does, and they'll go up by whatever the inflation rate is. Let's say it's 5%, so it goes up to 10,500, and then that stated interest rate of, let's say it's 3%. The coupon payment on the principal isn't applied to 10,000 any longer because the principal isn't 10,000; it's now 10,500. And so you should see a little bit higher of a interest payment. And so your yields go up as well. Now, that's the idea. And if you're looking, to protect your income and we're concerned about inflation, certainly tips can be a great way to do that. In particular, if we have certain needs in which we want a high degree of certainty as to how those are being funded. Tips aren't perfect though, and so one of the ways in which you can still see a loss, despite the fact that these are supposed to be adjusted by inflation, and they are adjusted by inflation, but they're also adjusted by the markets. And so if inflation goes up, but also the Fed rates go up, which is what we've seen here recently, uh, the underlying principal value of the tip is still governed by, what's out available in the marketplace. And so if the Fed has increased rates and now other bonds that are being issued have higher rates than what your bond had, and now instead of getting a bond at 3%, I can get a similar bond now at 4.5% or something, my bond now isn't worth as much because the rate that's being provided in recent bond issues is higher than the rate, but I could sell, my bond if I wanted to sell it to somebody else. And so what you'll see is, even though there's this adjustment for inflation, we're also seeing a pushing down on principal values. And so depending on what your needs are, especially if you're needing to sell out of the tip as an investment, or maybe it's held in an ETF, it will actually push down in value because of this the Fed increasing rates. And so these sort of things, all that to say, aren't guaranteed. But nonetheless, it tips overall, we have another chart to share with you on this, overall have tended to be with inflation, if not above inflation, about 69% of the time. So if inflation is a particular concern of yours, then having this as part of your investment portfolio can certainly make sense. And even more so if you're in retirement and needing to live off of your investments to supply a source of income to yourself, then certainly having an allocation towards tips can be an integral part or a meaningful part of that strategy. Anyhow, thanks for listening, folks. Hope that was helpful. Hope that explained a few things to you about the work of tips and inflation. And then again, be sure to subscribe to the YouTube channel, and then follow us on LinkedIn and Facebook, and consider signing up for the newsletter. All the links are noted below.